Welcome to Everything Explained. I am your host, and today we answer a big question with a simple goal: what is the difference between investing in markets and trading? People toss these terms around, but they point to different paths for money, risk, and time. If you are trying to decide where to put your effort, a solid rule of thumb is to match your approach to your life goals and your comfort with uncertainty. By the end of this episode, you will have a clear picture of when investing makes sense, when trading might fit, and how to avoid common mistakes. Investing in markets means buying assets with the intention to hold them for years, often through the market's ups and downs. The idea is to grow wealth gradually through compounding. You pick broad bets such as a market index or a mix of stocks and bonds that reflect the whole economy rather than betting on a single stock. The real trick is time. If you stay invested through many cycles, historically the market trends upward over the long run. You do not need perfect timing, you need time in the market. Common investing tools include low-cost index funds or broad exchange-traded funds, a sensible asset mix aligned with your risk tolerance, and regular contributions through dollar-cost averaging. The benefits are simple: lower stress, lower costs, and the magic of compounding returns over years or decades. The caveat is you will endure volatility, and you must resist the urge to withdraw when markets wobble, because selling during panics locks in losses and misses rebounds. Trading, by contrast, is about short-term moves. Traders try to profit from price changes that happen within days, hours, or even minutes. It is less about what the company is worth and more about what someone is willing to pay today. Traders use charts, patterns, and indicators to decide when to enter and exit quickly. There are different styles: day trading, where you close all positions by the end of the day; swing trading, which might hold for several days; scalping, which aims for tiny profits many times in a session. Transaction costs matter a lot here because you are paying more frequent fees and often tighter spreads. Risk management is essential. Many traders set stop losses, limit how much of your capital you risk on a single trade, and keep a trading plan with predefined entries and exits. Emotion also matters a lot more in trading. The fear of missing out, the temptation to chase a hot move, or the sting of a loss can derail a plan quickly. To make the differences concrete, here is a quick side-by-side view. Horizon investing looks at years and decades, trading looks at hours to weeks. Decision criteria: investing centers on fundamental value, company prospects, and how the world might grow. Trading centers on price action, momentum, and liquidity. Costs: investors pay mainly management fees and taxes on long-term gains. Traders pay more in commissions, spreads, and potential short-term tax rates, depending on where you live. Required capital and skills: investing often works with smaller, steady contributions and a good understanding of risk tolerance. Trading usually requires more capital, quick decision-making, and a solid plan for risk and psyche. Still, there is common ground. Both sides rely on learning about markets, about how assets interact with risks, and about your own limits. Both can benefit from discipline, clear goals, and ongoing education. And in practice, many people blend the two: a core long-term investment portfolio with a smaller portion allocated to trading or more active strategies. The key is to be honest about what you want from money, and to invest time in building the skills that fit that path. What is the bottom line? Investing is the steady uphill climb, building wealth through time, diversification, and patience. Trading is the fast tactical play, trying to profit from short-term price swings, with higher costs and bigger emotional stakes. Neither approach guarantees riches, and both require learning, practice, and risk control. If you are new, start with investing, set up an automatic plan, choose low-cost funds, and give yourself decades to grow. If you are curious about trading, treat it like a second career. Practice with simulated trades, define a strict risk limit, and only risk what you can afford to lose. The best plan is a clear goal, a reasonable time horizon, and the discipline to stick with it. That way you will have a path you can actually follow, not a fantasy you will chase. Thanks for listening to Everything Explained. If you are ready, take a moment to define your own goal, long-term growth or short-term opportunities, and design your plan from there. See you next time for more clarity, curiosity, and practical guidance. Take control of your future with a clear plan and the courage to start today.